Good afternoon. Today we'll be looking at IFRS 16 leases. Leases or a lease is a legal contract. It's a legal contract between lessor, owner of what? Of the asset, and what? And lessee, the tenant, where what? Where one party grant another party to use what? An asset for a specific period. That is the lease. In exchange of what? In exchange for what? Regular consideration or regular payment. So that is what we call lease. So when two parties come together, so one party owns an asset and another party also need that asset for whatever job the person wants to execute, the person can come to the other party to rent that what asset. So when that happens, they are forming a contract where one is using the owner of the asset, and then the one who is using the asset will be paying to the owner of the asset regularly. That's what they call lease. This is how it looks. So you have what? Company A leasing his asset to company B. So here you have what? You have what? Lease contract, right? After you've had what? Lease contract, then this person got, there will be a payment, which is what? The regular payment the leaseor will be received. So this person, the owner of the asset, is who we call what? Leaseor. And then the one who is renting the asset is called what? The lessee. This is brief what explanation to what lease is all about. Let us look at two main types of what? Of lease. Now we have two main types of lease. One is what? Is finance lease, and two is what? Operating lease. Now let us take them one by one. So one is what? The finance lease. What does it mean? The finance lease, one, risk and reward. Are what? With the lessee. Two, the lessee has the option to own or buy the asset at the end of the lease term. So when we look at the finance lease are the period of agreement. The lessee, the one who is renting the what? The asset has what? Has the prerogative to own the asset at the end of the lease term. So here, what this means is this: when asset is what? Is leased out to the lessee under finance lease, the agreement is that the lessee has option to own the asset. For that reason, risk and reward are what? Are with the what? With the lessee, where the lessee will own the asset from the beginning, and he will what? He will make use of the asset without any interference from what? From the lessor or the owner of what? Of the asset. And the finance lease, all the control, everything is in the what? In the hands of what? Of the lessee. So at the end of the term of the lease, the lessee has option to what? To own it outrightly. That is what we call finance lease. So here, the risk and reward are what? Are with the lessee. Because at the end of the day, the lessee has taken control over the asset. So since he has taken the control, he decides where and when to use the asset. He decides where to move the asset to. He decides who mans the asset. So that is finance lease. So the lessee under the finance lease own what? Has total right over the asset, how to use, where, and how to manage the asset. And three, it also has what we call long-term arrangement. So the arrangement and the finance lease can also will be a long-term arrangement between the two parties. Because of the nature of what? Of this arrangement, they can go into a contract for a very long period, because at the end of the day, the likelihood of what? Lessee owning the asset is very high. All right. So let's look at operating lease. Now, under the operating lease, risk and reward is what? Is still with what? With the lessor. So the lessor still what? Has right, has control over the what? Over the usage of what? Of the asset. So here, the lessor has what? Has control over the asset. What this means is that if you went for operating lease, in this instance, you have a concession for mining and you needed machines for excavating the land. So you went for what? For machines under operating lease. Under this arrangement, the lessor or the owner of the machines will come to site and do the work for you. The asset is still in the control or is still in the hands of what? Of the owner of the asset. Where the owner of the asset takes control, he brings the workers who will man the machines, operate it over the what? Over the agreed period, and move out with the machine back to where it came from. You see, so here the risk and reward is still in the hands of what? Of the lessor. When you compare that with what? With the finance lease, here the risk and then what? Rewards are still with the lease, are still with leasee, because asset has been given to the person, to the lessee, for a long period of time, and he will have control over the asset. So the lessee will rather employ people to come and use the asset. But when you come to the operating lease, under the operating lease, the owner of the assets will still control where and how to manage this asset. The risk and reward are still with what? With the owner of what? Of the asset or the lessee. Under the operating lease, it has what? Short-term arrangement. So unlike finance lease, which has what? Long-term agreements, operating lease has what? Short-term. So if it is 5 years, 5 years. If it's 10 years, 10 years. But finance lease can expand more than that, because usually finance lease arrangement can even be in tandem with what? With the useful life of the asset. So if the asset's useful life is maybe 20 years, the lease agreement can also go in that direction. But with operating lease, no. It's a short-term arrangement where the period of what? Of the lease term should not expand beyond the what? Useful life of what? Of the asset. The reason why it's what? It's short-term what? Arrangement. The lessee has no option to own the what? The asset at the end of what? Of the lease arrangement. All right. So these are the what? These are the difference between what? The operating lease and what? And finance lease. Okay, let's look at exemptions. What does not constitute lease agreement? So here we have what? Short-term lease, where the lease agreement is what? Less than what? 12 months. You understand? You understand? So if maybe you have company A, that's is leasing is what? Is asset what? Company B. So you have what? Lease contract between the two parties. So here the lease arrangement is less than 12 months. The lease payment shall be what? Shall be treated in the profit and loss. You are going to make payment of this lease arrangement less than 12 months. Then you don't need to what? You don't need to capitalize the lease into your statement of financial position for a long period. All you have to do is that you have to what? You have to write it off in a what? In a profit and loss account as expenses. That's all. So this is one exemptions of what? Of lease. One exemption of what? Of lease, which is what? Short term. The second exemption is what? Low value asset. Now, if the underlying asset value is 500 or less when new, these ones cannot be what? You can't use this asset nature to go into lease contract. So these are the two exemptions. Low value asset what? Lease. So if the asset has what? a value less than what 500 US dollars or 500 US dollars, then because of the nature or the value of what of the asset, we cannot use it as a what as a basis to go into a lease contract. So these are the what two assumptions to what to lease arrangement. So if you find a situation where the asset has short-term lease arrangement, you cannot what treat it as what as a lease. Just write it off in the P&L. The same applies to low value assets. So if you have a low value asset of 500, such arrangement, maybe if you have a washing machine and you want to enter, so what is the value of washing machine? Okay, so you want to enter into, so you look at the value of the assets if it qualifies to what to be used as what as a lease in a contract or not. Now let us look at what measurement. We'll look at the initial measurement of what of the lease arrangement. Now, under the measurement of what lease arrangement, we have so things that what you should consider are the lease term. So you look at what lease term, example, the number of what example, the number of what of years in the what in the agreement. Two, lease payment. Example, how much is paid for the usage of the asset annually. Discount rate. Now, in a lease agreement, discount rate is what is used. We call it what implicit rate. That is cost of what capital of the leasee. Now we use this one to calculate what we call your lease liability. You are to pay over the what over the lease agreement, right? So example, if maybe you have your annual lease payment is 200, and but what the term of the lease is 4 years. So it means that you are going to pay 200 plus 200 plus 200 plus 200, which is 4. So this is supposed to give you how much? 800. Now this 800 is what we term as what your lease liability over the what over the 4 years. Now this lease liability 800 is what you are supposed to pay for the 4 years. Now because of time value of money, this is expected future expenses that you are going to make. So for that reason, you need to discount this money to the present value. So that's where we use the discount rate to calculate for present value for the money. All right, so that is it. So, and the fourth item we also need in our measurement is what we call what right of use of asset. Now, right of use of asset is also known as ROU of what of asset. Now, right of use of asset is like when you are acquiring an asset, just like you are acquiring an asset. So when you come to IFRS 16, the asset that you are holding, you are using it for economic purposes. Now, if you are holding an asset in the form of lease arrangement, these two things come to play. One is what? Control of what? Of the asset. And two, economic benefit flows to you. So you have control of what? Control over the asset or of the asset, right? Economic benefit also flows. So these two elements forms part of what? Definition of what an asset is. So what an asset is, these two elements what qualifies to the what this definition of what an asset is. If so, then it can also what come under what? Under IFRS 16. Because at the end of the day, you are controlling the asset, and then the usage of the asset also flows. The usage of the asset, which brings economic benefit, what flows to you. So the reason why right of use of asset also goes under under statement of financial position, and is under non-current asset. So under non-current asset, you have it as right of use of assets. If so, then how initially asset is acquired and all the costs, including incidental costs, are consolidated or added to get the initial cost of the asset. The same also applies to right of use of asset. So right of use of asset is also one on current asset element. When you have right of use of asset under the IFRS 16, we treat it as you've acquired asset under IAS 16, just like that. So, example, if you have under IAS 16, if maybe you acquired cost of asset, you acquired assets, maybe you purchase machine at the cost of 400, and they gave you discount of 10%. Now free charges on this machine is 10. You have import duty 20. You have transport cost 10, and then preparation of land to place the machine there is also 5. So this is how initial recognition of IAS 16 asset is done. So you acquire this asset. All that follows are called what we call incidental cost. So when you bought this machine, they gave you discount of 10%. So they gave you a discount of 10%. So when you calculate 10% on 400, it gives you 40. You see? So it's something that they've given to you because you bought the asset. Now the rest, you need to capitalize them. You add it to So when you buy how much you bought the asset is not the actual cost of the asset. Any cost to bring the asset into its final usage are all capitalized. So here, when you add them, what do you have? So here, when you add them, you will get 405. So this becomes your total cost of the assets. Now, so here the same thing applies to right of use of asset here. The same thing applies to right of use of asset here. So with right of use of asset, assuming you have one falls under IFRS 16. So under 8, assuming you have to pay for the usage of assets. So that becomes your lease payment. So your lease payment is maybe 200 every month, and the term to pay this lease is is 4 years. So when you multiply 200 to 4, that gives you how much? It will give you 800. So this is lease payment, total lease payment. Now this total lease payment, we need to discount it to the present value, right? So discount it to the present value. So if assuming we have 10% discount rate, so when we discount this 800, what do we have? When we discount, so how do we discount it? We discount it by by using what we call annuity formula. Because the payment is regular, 200 every year, you use annuity formula to work on it. So this is the formula for annuity. So 1 minus into bracket 1 plus r over r, all to the power of negative n. So with this one, what do you have here? So you will have 1 plus 1 minus into bracket 1 plus 10% to the power negative 4 years. Term is 4, right? So over 10%. What do we have? So that gives you how much? That gives you 3.17. So this 3.17 is what? So now you have you will have your 200 that you pay annually, that you multiply by 3.17. This gives you how much? So this gives you 6 634. So instead of 800, you should discount to 634, right? So this becomes your what we call your lease liability. So as I said, so this becomes your what? Your lease liability. So this becomes what you are expected to pay, which is what? 634. Okay, so now you know your lease liability. How do we find our right of use of asset? So lease liability. So this is what you expected to pay for the usage of the asset. So if you are paying, it is like this becomes your initial purchase, just like your initial purchase of asset. This lease liability also becomes your initial payment for the usage of the asset. So the same thing. So here, that is where your right of use of asset comes in. So under your right of use of asset, you have what your lease liability, which is how much? 634 becomes your what? Your lease becomes your right of use of asset. If there is no other cost associated with this, then your right of use of asset is the same as what your lease liability 364. But if there is any discount they are giving it to you, so in this instance, you will not see discount. What you see what? Incentive. So if they are giving you incentive of maybe, then you will less it. If there's any additional cost, maybe 400, then you add it. So that gives you what? That gives you 644, right? So this becomes what? Your cost of what? Of the asset. So just like you are reporting in in your statement of what? Financial position under non-current asset, just as what you report machine under IAS 16, the cost is how much? 405. You also report under the same non-current assets ROU, right of use of asset, which is under what? Under IFRS what? 16. The cost is what? 644. So this is how right of use of asset is what? Is reported under the what? Under IFRS 16. Okay. So now the fifth one is what? Determine your what? Your lease liability. So you determine your lease liability. So your lease liability is what? How much are you expected to pay over the period of what? Over the period. So if you have TK Limited agreed to what? To lease an asset for 5 years. Annual lease payment is 400. Cost of capital. Capital is what? 10%. Determine lease liability. So how do you determine lease liability? So here, how do you determine the lease liability? So actually your annual lease, so determine your lease liability. Actually your annual lease payment. Your annual lease payment. So you have your annual lease payment to be how much? You say 400. It's in there. 400. Now, when you look at this, you have what? Annual lease payment. So you have your annual payment, which is what? 400. And you have what? The term of the lease, what? 5. So when you multiply, you are supposed to get how much? 2,000. So for the period of what? 5 years, you pay 2,000 for the usage of the assets. Now, in accounting, when you have what? Expected cash outflow, this money has what? You need to what? Discount this money to the what? To the present. You need to discount because of time value of what? Of money. So with that, we use what we call annuity factor. So the annuity factor formula is 1 minus into bracket 1 plus R, all divided by R to the power of -1. So you can use two methods in actually to find your present value of your regular payment of what? 400. So when the payment is irregular, you use annuity factor. Okay. So you remember the formula. So what do? So you have what? Your 1 minus into bracket 1 plus discount is what? 10% to the power -5 years, all divided by 10%. Okay. What do we have here? So you will have 3.79. So you multiply 3.79 by what? by 400. So that gives me 1516. You see, this is my present value, right? So this is my present value. Now compare. So instead for you recording 2000 as your total lease liability, it should rather be 1560 to the present value. So we can equal what? Get this one through what? Through this mean. So you have what? Years. You have what? Your cash flow. You have what? Your DCF. You have what? Your present value. Okay, so here 1, 2, 3, 4, 5. So cash flow, your regular cash flow is 400, 400, 400, 400, 400. Okay. Then you have what? The interest rate is what? 10%. Okay. So with this one, this is the formula you use. The formula you use for this one is what? Is DCF, where you have what? Your 1 plus R to the power negative n. Or you can do it this way, 1 over 1 plus R to the power of what? N. Okay, I will choose the first option. All right, so you pick year 1. So year 1, this is the input. Year 1, the input will look like this. Year 1, the input will look like, you have 1 plus, the rate is what? R is what? The rate, which is 10% to the power of what? Negative how many years? Year 1, right? Okay, so what do you get? I get 1. All right, so year 1, my discount factor is going to be 0.909. Then I'll multiply 0.909 by 400. So that gives me what? 364. Then I will substitute the same. I'll use the same. So year 2, you remove 1 and you put 2 there. So year 2 will be what? 0.826. Okay. I'll multiply by 400. I'll get 330. Okay. Year 3 will be what? 0.751. Okay. That gives you what? 300. Year 4 will be 0.683. So that gives you what? 273. Okay. The final year will be 0.621 times 400. So that gives you 228,248. All right. So that is it. When you are done, then you sum them up. Whatever you get will give you the same results. Okay. So you will get up to 1515. So the same. This one approximated this one. So it will give you the same outcome. All right. So whichever you want to use is a choice. All right. So when you are done, then you come and do your what? Your amortization. You come and do your what? Your amortization and what? You calculate your what? Your depreciation. All right. So these are the what? These are the key elements that needs what? That needs what to be looked at whenever you are considering IFRS 16. Now that you know our initial method, let us look at our subsequent remeasurement. Now, subsequent remeasurement. So under the subsequent remeasurement, what happens? So with the subsequent remeasurement, there are triggers. One trigger is what we call change in what? In lease term. So under the change in lease term, it means that if company A lease its asset to company B for 4 years, there is an option to extend the years by 3. Company B accepted to extend the option. So when this happens, we call it a change in lease term. So you realize that first, this is the arrangement. So the first, you have what? 4 years contract. Then you have subsequently. So here, company B accepted to extend the option. Company B accepted to extend the option in the second year. So here, you have what? 4 years agreement with the person. They gave you option to extend the what? The lease term by 3 years. So you agreed in the what? In the year 2 to what? To end of year 2, or let me put it end of year 2. So in here you have the mandate to use the machine for 4 years. Now the option is what? Accepted by company what? Company B. What do you think will happen here? You have already exhausted 2 years. Well, listen, he say he agreed to what? To extend the option in second year, end of second year. It means the mandate of 4 years, you've spent 2 years before you decided to what? To accept the option by what? For the 3 years. So here you have what? 4 years minus 2 years that you already spent. You have for 2 years left plus the what? Plus 3 years that you have 3 years option. That gives you how many years in all? 5 years. You see, so this is what we call what? Changes in lease term. And these changes in lease terms will affect your lease liability. We'll get there. Now, two, changes in what? Variable payment tied to variable payment tied and what? An index or what? Or rate. Okay, so let me give you this example. So if you have what? KTU has lease agreement with what? KT Limited to use an asset for 6 years. The lease payment is what? Subject to change in what? In every 2 years. Every 2 years based on what? CPI. We call it Consumer Price Index. This determines the purchasing power of what? Of consumers in a country. So it is measured by what? Ghana's measured by statistical service, right? Okay. So here is the kicker. So if one lease payment at the what? At the start, which is 1st January 2020, is 400. Two, CPI at the start, that's 1st January 2020, is 100. Three, CPI at year 2 ended is what? Is so you have it here. What do? You have something like this, and then it starts what? To index. I've already explained what the consumer price index means. So here all you have to do is that here you first calculate your what? You first calculate your what? Your lease liability. Your lease liability, you have your what? Your annual lease payment. So annual lease or your annual payment, your lease payment is how much? It's 400, right? Then you'll find your what? Your annuity factor, which is what? 1 minus into bracket 1 plus R to the power of R. Now you have what? So let me add what? Costs of capital. Cost of capital is 10%. So you have it here. How do you go about it? So you have 1 minus into bracket 1 plus 10% to the power of what? 10%. Negative how many years? 5 at the beginning, or 6 years, right? 6 years. Okay, so you have what? 1 into bracket 1 point. Okay, so you have it there. Negative 6, 10%. Okay, so you have your rest of 3, 5, 5. Okay, so you have times 400. So this becomes your what? Your lease liability. 104, 174 becomes your lease liability for the period of 6 years. In the middle, so this is the initial. So at the middle, they said that this your lease payment to what will change over the period. So how is it going to do? They said that it will change after 2 years. You see, so 2 years down the line, what happens to what your lease life? By the time that you thought you've changed your what do you call it? Your lease liability. Your lease liability has already gone into what we call your amortization schedule, where you have what you have. So this becomes your amortization schedule. So this is how it looks. So if you are paying at the end of the year, you have your balance brought down here. You have your interest here. You will have your payment here, your lease payment here. You also have your balance carry down also here. So this is how it will look in your book. Okay, so your lease liability year one and year two. Your lease liability is 174. Then you charge the interest of 10%. That gives you 17.4. Your lease payment you are paying annually is what, 400. So you will have what, 208.6. So this becomes your what, your closing here, become opening here. Then you charge what, interest on this one. That gives you what, 20 point. Alright, so you'll have what, 170.5 here. Okay, so here, this is what you have here. And they said that in year two, your CPI will affect your lease liability. That's what they said. So they said every 2 years, your lease payment will change. So if it is changed, this is what you call modification of what? Modification of lease liability. So how do you modify it? You already have your existing what? Lease payment. Your existing lease payment is how much? 400. And they said that this 400 will change after 2 years. Yes, so you have to change it. How do we change? We change it using what? Your CPI. And your CPI, initial CPI was what? Was 100. And the rest current one is what? 103. All divided by what? By the previous, which is 100. Check it. So you see it 100 and then 103. Okay, so when you multiply, what do you have? You divide. So when you divide, you have what? 1.03. Then you multiply 1.03 by what? By the 400. What do you have? You'll get what? 412. Have you seen that it has increased by 12? So this becomes your new lease liability. Good. So now you have it here. So if that's your new lease liability, then when you come to your table here, you have what you call remeasurement, because you've remeasured it. So if you've remeasured it, then what happens is that your balance sheet, you have it here, you will bring it here. So then how much is your balance? Your balances, first balance, you bring it here. Nothing happens to it. So 208.6. And year two, they told you that your lease liability will change. So that's what we just did here. You see. So if it is changing, how much is it changing? It has changed to what? It has changed to 412. So once you now know your new lease liability, what do you have? So now that we know our new lease payment, so this becomes our new lease payment. So this is what your new lease payment, right? So now after you calculate, you have what? Your new lease payment. Okay, so now you know your new lease payment, then you calculate your what? Your new lease liability. You will start for your annual lease payment. How much is it? 412. Then you calculate your what? Your annuity factor, all divided by what? Your R. So what do you have? You have what? 1 minus into bracket 1 plus interest rate is already 10%. Our interest rate is what? 10%. Okay. And again, now how many years left? You've already spent 2 years before the new lease. So the total lease term was what? 6. You spent 2. So you have 4 years left. Then you come and multiply 4 years. Okay. So what do you have here? So that gives you what? 3.169. So when you multiply, what do you have? So you have total of 135.9. So you'll have 1306. So this becomes your what? Your new lease liability. So if that is your what? Your new lease liability, then you realize that your year 3 will not be the 170 as your what? Your liability. Rather, your new lease liability that you calculate, which is 1306. Okay, so I think this one will be, so I think that's all. Let's check the first. So here will be what? 1742. Okay, so you will be 1742. So for that reason, this place will also be what? 1000. Okay, so let me do this correction. So we have 174.2. 174.2 minus 400. Okay, let me correct these. Okay, so here will give me balance of what? 1516. So 1516. So interest will be what? 151.6. So that gives you 127.6. Okay, so this is what you have here. Now that we now know our new lease liability for the year 2, then that is what is coming to replace this one. So here you have what? Here you bring what? You do your remeasurement, bring your balance CD. So because of what? The amendment done to your lease liability, this one comes, so you have 1516. Then your new lease liability that you calculated will come at the end here, which is 1306 here. So the difference between the two is what we call remeasurement. We call it what? Remeasurement. So 38 points, right? Then this one will be the opening for what? For the year 3. 136, then 13.6. Now your new lease payment is what? 412. So this is how the remeasurement or modification affect your lease payment. That is a brief explanation to the subsequent measurement.